Hi, good morning, everybody. Thank you for taking the time to join. I can see a number of people joining the session now, so I'll give 20 seconds or so, and then we'll get started here. Okay, great. So I can see that number stabilizing out a little bit now. So thank you, everybody, for joining. I'm Adam Granger with the Fixed Income Investor Network. And thanks for joining the Consumer ABS Task Force at the Distressed Credit Trading and Asset Performance Update, which is supported by SOL Advisors. Throughout today's session, we encourage attendees to pose questions to our panelists through the Q&A radio button at the bottom of your screen. If there's anything you missed during today's program, this content will be available for viewing on the IMENT website after the program has concluded. Now, with all that said, I'd like to hand things over to our esteemed panel and our moderator, Stacey Schachter, President and Chief Executive Officer at FIIN Investments. Thanks, Stacey.
Thank you. I'd like to start off by thanking the Fixed Income Investor Network as well as IMN for putting this on. And because I don't want to forget later on, I'm going to thank my panel now for joining us, or in Jennifer's case, maybe joining us several times for multiple sessions. We are talking about consumer ABS in this session. We may touch on some commercial issues depending on timing. There is a commercial panel, I believe it's at around 2 o'clock or so as well, which I would recommend everybody join. I'm going to let the panelists introduce themselves and tell you a little something about themselves, and we'll start off with Jack.
Great. Thanks, Stacey. Hi, everyone. I'm Jack Irvesty. I co-lead the consumer and ABS vertical within the asset-based finance business at KKR. I also chair the consumer and ABS task force for the Fixed Income Investor Network. I joined KKR as part of their acquisition of Global Atlantic in February. Prior to that, was at Global Atlantic for 5 years, also focused on consumer and ABS. And before that, I was at Credit Suisse. Just in terms of our current book of business, the consumer ABS book is about $5 billion of Global Atlantic's $80 billion balance sheet, and we invest across whole loan assets, private financings, and liquid CUSIPs, with the bulk of the focus for the last few years being on consumer assets. With that, I'll pass it to Jennifer.
Thanks, Jack. Hi, good morning. I'm Jennifer Thomas. I'm a senior analyst at Loomis Sayles with a focus on consumer ABS. We generally are pretty active in the consumer ABS space. Of our $30 billion securitized book, $6 billion is in the consumer space. We focus on going up and down the capital structure. At this time, we're not doing whole loan purchases, but we continue to look at all different opportunities and be very active in the space. And I'll pass it off to Colin.
Good morning, everyone. My name is Colin Bihar. I'm a portfolio manager at Britannia Asset Management in London. I have been with the firm for 8 years now, and I invest amongst other things in consumer assets and bonds in particular, both in Europe and as the case may be in the US. We invest across the capital structure for various funds and mandates, both at the most liquid end of the spectrum and the more senior assets, and down to investment grade mezzanine bonds and more residual assets of, in general, of a slightly more esoteric or unusual nature as a principle.
Okay, thank you, panel. And Colin, you really have a great radio voice. I don't know if you've been told that.
It's been mentioned a couple of times. Thank you very much for that. Always appreciate it.
What we're going to try and do for the next 40 minutes is talk about some, obviously we can't cover all of consumer ABS. So we're going to try and do some general, talk about a couple of sectors, and then move into some more esoteric areas. As you were told at the beginning, we want to take your questions live, and as soon as you get them to us, we will present them to the panel at the next opening, rather than try and holding things for the end. And with that, I want to try and just set the table a little bit as we talk about consumer ABS. In 2020, consumer ABS was about 128 billion in issuance. It's forecast for 2021 to be about 160 billion in issuances. So obviously things are going up. However, if you look at Vantage scores anyways, none of that has trended negative yet. Delinquencies are still below pandemic levels. And I think there's a lot of uncertainty is exactly what the data is showing. So to help set the table, we're going to ask Jack to sort of give us some broader indications about the various markets, and then we'll roll into Jennifer. So with that, if Jack, I'll throw it over to you, and perhaps maybe we can get our first slide.
Great. Yeah, so one of the things that we've talked about in pretty much every one of our task force meetings over the last 6 to 12 months is kind of the relative performance of different consumer sectors where we're seeing or not seeing cracks. And I think the interesting part has been that in terms of actual delinquency and default performance, everything's performed pretty well across the consumer space. There are clearly some losses taken in places like unsecured small business, but looking at the consumer universe as a whole, it's been pretty protected. Looking a year ago, there was a substantial bifurcation that we saw in terms of forbearance rates by sector. But as that's played out and on the back of the stimulus, we've seen pretty much all of those sectors recover and reperform, with most at relatively low levels of deferral today. And a lot of that can be attributed to the stimulus that we've seen, but I think the challenge for everyone on this call is kind of parsing through what happens, right? And I think the question that we were going to discuss here is what happens if and when that stimulus wears off. And so I just want to highlight a couple things on this chart that our economists put together that I thought were interesting. If you look at low wage workers, the top left graph, they've experienced the steepest loss in jobs and in wages since the pandemic. You look in the bottom left, they've actually experienced the highest growth in income. So it leads to kind of an interesting dynamic where, I guess in my view, the prime borrower is fundamentally in a better position. Prime, higher income, I'm using those interchangeably, but it's not always the case. And the kind of lower income subprime borrower is maybe in a weaker fundamental position on a relative basis, given the job loss and the weaker balance sheet, but they actually have higher near-term incomes and you're earning more carry on that borrower. So, I think the interesting piece of it is until the stimulus wears off, it almost feels to me like subprime will outperform because you're earning higher carry and the losses are pretty low, and the incomes have actually exceeded growth seen in medium and high income households. Whereas once the stimulus wears off, I would probably expect to see the opposite trend where prime would start to outperform and subprime would underperform. So it almost becomes a stimulus timing question. But I think that this is certainly something that we have talked about and debated over the last 6 to 12 months, because I'm not sure that there is a right answer there.
And Jack, you mentioned early on about sort of the performance and the forbearance and these payment holidays. In student loans, the payment holidays are going on, it seems like forever at very high levels. Mortgages, 1.59% of mortgages are in forbearance. Pre-COVID, it was 0.05%. Credit cards, 2.56% are still with these payment holidays. And so you get the combination of the payment holidays, plus you have the just all this stimulus, coming in. And that, of course, is why these delinquencies are so low. But how do you factor that in? Like, if you're thinking about ABS going forward, right? And a typical securitization goes out for many years. How can you look at the data and try and understand what's going to happen 3 years down the road? I mean, that's what we all seem to be struggling with.
Yeah, I think that's an interesting question. And I think that student loans are an interesting asset class in this day and age because, there's a few dynamics at play there, right? I think number one, we saw pretty outsized increases in forbearance in, last March, April, and May relative to, other asset classes of kind of comparable credit quality. And then, since that time, you've had everyone's federal student loan payments on holiday, and that holiday is now extending through September of this year. So what that's meant is that on the private student loan space, which is, mainly where a lot of the securitized activities focused, your borrowers there have actually had more cash in their pockets to make payments because they're not making payments on their federal loans. So, I think the question with regard to private student loans is kind of what does that performance look like when that payment holiday ends and there's the effective payment shock. Let's say it's in September from the resumption of federal loan payments. So I think that's one question. And then, the other question is around forbearance. And, you mentioned that forbearance rates are still elevated. I think one thing we've seen is in our portfolios and in the broader market, the higher quality, true private co-signed underwritten student loans have mostly reperformed and forbearance levels have kind of recovered to around where they were pre-pandemic, maybe a little bit higher. Forbearance has kind of always been a facet of the student loan industry. So you kind of have always had some level of forbearance in these portfolios. And we've really seen most of the borrowers reperform. So I think in my mind, a lot of the forbearance sits on the FFELP side, which raises other issues with extension and maturity risk. But on the private student loan side, I think one of the big questions is how much payment shock do we see, in September or whenever federal loan payments resume. And frankly, I think that's a challenge for everyone who's trying to forecast these assets. I think on the one hand, you've got a borrower who, is generally in a pretty good position, has had a chance to delever, but on the other hand, is going to see a meaningful increase in their payment obligations.
Now, Jennifer, I know you have an interesting stat that you wanted to share.
Yeah, I think, what really put it into perspective for me was Equifax had recently published some data that said that 24% of the total outstanding student loans, which actually totals $283 billion are in forbearance. That is greater than the total amount of lending done in the private label credit card space and personal consumer loan space combined. That is a lot of debt that is currently not being paid. Granted, most of it is outside of the ABS market and held on the balance sheet of the Department of Education, but it's a huge factor that has to be considered when thinking about payment priorities and what will happen going forward.
Totally. I mean, I think one of the ironic things though is before all this played out, one of our thoughts was, well, if suddenly people don't have to make payments on their federal student loans, are we going to see weaker performance on the private student loans because people will think that they don't have to pay those either? Are they, why should I pay? And we've actually seen the opposite, where we've seen people making more payments because they have more money available to make those payments. But I totally agree that the federal student loan area is a mess, and the resolution of that mess raises questions for the broader market as a whole. And I think, historically that had led the sector to trade, at a discount to others or wider than some of the other sectors. I think surprisingly in the last 12 months, we've seen that trend kind of evaporate and that market has ripped tighter. And, it seems like the broader investment community is less concerned about that now than they were 12 or 24 months ago, which is a surprise.
I would have to agree with that.
Yeah, so we could just keep talking about that, but I want to get into some sector specifics. Jennifer, I'm going to throw the ball to you, but just hold on for 1 second,
Okay.
because we're going to try and get some audience participation as well. So we'll see how that works.
Okay.
But I have a question for the panel, which you can think about, and as we have time, we'll come back to it. But Jackie, you're talking about how you expect those roles between subprime and prime to sort of, go back to normal almost. But most of the stimulus is actually being used, and a lot of it is being used to pay down debt. Savings rates are much higher than they've been in, well, since the Great Recession. And instead of buying consumables, again, a lot of what we would consider to be subprime is using that to pay down obligations and otherwise increase savings. And so when the stimulus stops, I think one of the open questions is, will that savings continue to prop up ABS for years to come, or is it very quickly going to go back to the way it was? And if the audience would like to weigh in on that, we'd love to hear from you. And so stop your multitasking and get in and get that information to us. And with that, Jennifer, I think you had some slides and you wanted to talk about some sectors here.
Yeah, so actually to your question, it goes pretty well into the subprime and deep subprime market. One headline that you continuously see, or actually we haven't seen in a while, so shockingly, we've been out of the press, is the subprime auto space and really what's going on there. I think, just highlighting what we've seen in trends in the market is also important in thinking about subprime borrowers. Subprime and deep subprime financing has actually reached an all-time low. What you're seeing, at least in the auto lending market, is a push for more prime borrowers taking advantage of lending. A lot of that is related to the fact that vehicle prices are at all-time highs. So you see the lending changing, as well as CAP just made a big push to the prime lenders, and especially during the pandemic was key. As we saw lending, when the pandemic first started, subprime lending kind of stopped. People kind of went into shutdown mode as they tried to figure out what was going on. You saw that the lenders kind of went from the box is open, the credit box is extremely tight now, and then slowly opened it up a little bit as time went on, but have really not gone back to a full range of where we were, say, a year ago, or actually at the start in 2019, I should say. Now it's been a year, time flies. And that gives us a lot of thought about what is going to happen to subprime and deep subprime lending going forward. I mean, what you probably have now in our expectations, better quality subprime lenders, borrowers than you had seen before because of the tighter underwriting box, which should help performance and be able to write out maybe some of the bumps that Jack was mentioning before. I think what's interesting, if we could flip to the next slide, is looking at how modifications kind of played out during the pandemic. Initially, you had a kind of a hodgepodge of what went on in the modification process or payment extensions. You had some lenders, specifically on the prime side, just give a payment holiday to everyone. It was okay, it was 90 days. And that was really what you saw on the prime side. It was quick, but then it returned to historical norms when everyone didn't know, do we need this cash holiday? We need some help. And same kind of occurred on the subprime side, but what happened, I think, on the subprime side, at least when we spoke to many of our issuers, which saw modifications and extensions jump to high 20% area of certain deals, was they were doing them in 30-day increments in ways to continue to stay in touch with the consumer and know what was going on with that consumer at that time and better address and service them, which was key, I think, to now how we have seen the modifications and extension rates go back down to historical levels. And it kind of, we saw a quick uptick, I think, in December of 2020, kind of as you felt right before that stimulus came. We saw some of the subprime borrowers kind of struggling a little bit, but that quickly changed again as that round of stimulus came through. I mean, it shows that extensions work, and the need to do them on a 30-day basis seems to really work well with the consumer and for the issuers staying in touch with the consumer. And most of the prime lenders really didn't need it, or borrowers didn't need it. It was kind of a sense of panic or just, oh, it's there and taking advantage of it. So a lot of the trends that we saw were positive, and now we've seen these extension rates return to the historical level norms, as well as delinquency rates are down as well. So things look good from the auto side of ABS right now, but you can, to Jack's point, we really have to think about what will happen a year from now when the stimulus is gone and these benefits aren't there.
Well, going back to the question that I sort of posed to the panel, you said there was some softness in December. And you could take a look at your chart here and you can see it is almost immediately beginning to trend back up when that stimulus ended. And so is that the answer? That or that despite savings and everything else, that things will very quickly go back to the norm. And when I say the norm, I'm not talking about the norm in terms of January of 19. I'm talking about let's look at more in July or or September.
Right. I mean, from my opinion, or anecdotally, in talking to, we polled a lot of the issuers during the time just to kind of get a feel of what they were hearing from their borrowers. And it was that most of them had used what little savings they had accumulated up by the December time period, and they were kind of back to where they had come. I think, some of the savings numbers are skewed definitely towards a different type of borrower than you may be seeing in a low subprime, deep subprime deal, to be honest. These borrowers also are benefiting from some rent moratoriums and eviction moratoriums, so they're not having that cost as well, so they're able to continue to pay their vehicle. And our belief is the vehicle is still important to the consumer and high on the top of the list because they needed to get to work. So I believe that staying high in that payment hierarchy will continue, but they were feeling some pressure come in December as they had kind of worked through their savings that they had built up. The world was kind of starting to open up again. People in some areas were going back to work, childcare costs were kicking back in, and the world was kind of starting up again a little bit.
Yeah, I think two things just to echo from what Jennifer just said. Number one, I think, to the question from the audience, I think that's right. The savings will bridge part of it, and it's not like the minute the government stops sending stimulus checks, there's going to be a big problem. I think it's a question of how do you measure the kind of end of government stimulus period, and I think that's a combination of the expiration of some of these unemployment benefits, as well as just the amount of time required to work through some of that money. Because right now, incomes are up from from a lot of these unemployment benefits, but ultimately, if we are not able to get people back to work, ultimately that will run out at some point. So I think that question there. In terms of the time frame and what we see. And then I think the second point is just, we have in the studies that I've seen that look at kind of marginal propensity to save versus marginal propensity to consume on the stimulus checks, it's definitely tiered by income. That said, we have seen kind of an across the board decrease in revolving credit utilization, which I think is positive for the entire consumer spectrum and buys everyone a little more time.
Now, Colin has been very, very patient, and we're going to ask him to be patient just a little bit longer. Although this is open to the entire panel, and this is where panel members get angry at me because I ask questions that we didn't prep for. But with respect to, we can talk about auto as an example. According to the stats that I have, it's about expected auto secure ABS for 2021 is about 118 billion. And we're effectively still in a zero interest rate environment. Given that this is probably the last round of stimulus, what do you think that does to pricing and ratings?
Oh, that's a hard one.
In terms of, I would say right now, we've seen for the first 2 months, 3 months of the year, extremely strong demand, and pricing has only tightened. I think in the last, call it month, I don't know if it's supply fatigue or, just the general kind of concerns around inflation inflation and rising interest rates, but we've seen a little bit of softness. So I think to the extent that we see, some of these inflationary pressures continue, interest rate concerns, and paired with high supply. I mean, I know Stacey mentioned at the beginning, at the beginning of the panel, the difference between this year's expectation for issuance and next year's. I think everyone on this call would probably agree with the sentiment that there seems to be a lot of money out there right now, but that can certainly change on a dime, as we saw a year ago. So wouldn't be surprised if later this year you saw a little bit of pressure driven by kind of a combination of all those factors.
All right, well, Colin, we appreciate your patience in getting to you. I know that you have a viewpoint with respect to what we might call esoterics, such as marketplace lending, et cetera. And perhaps you can give us your viewpoint on that sector for the coming year.
Yeah, sure. And I think it links perfectly to what we just discussed. And as a starting point, I would say the increase in savings rates, so the public support and monetary support, has certainly been great in terms of asset performance for these sectors. Perhaps one difference has been that the origination, the actual underlying origination in these sectors has also dropped much faster, partly because of the type of funding used and available to the originators in these sectors. You've just seen in these more fringe types of parts of the market, you've seen more originators stop their origination or stop originating at all, or decrease their risk taking and their origination bans severely. And therefore, perhaps what you see that in issuance number in ABS now, as perhaps is not necessarily the case in the wider ABS markets. And then you can see that by comparing for example, the auto or student loan issuance that is up year to date from the previous year or two, whilst looking at marketplace lending, obviously, it's a much the picture is much more nuanced by originator in particular, but even for the market as a whole. I guess to come back to the earlier point on the macro picture, these products are, be it more subprime credit cards or consumer loans unsecured, are inherently very short, and therefore simply by providing that government support and that government stimulus and allowing some of these weaker borrowers or potentially more challenged borrowers by the crisis, just by allowing them to pay for these bills for an extra 6 months, 12 months, 18 months, you already reduce the risk substantially for these shorter exposures. Perhaps not as much for, say, longer term mortgages they might have or student loans even, but for the very short exposures, allowing them to meet the day-to-day bills for a year makes a very big difference in terms of the actual remaining risk in these assets. And I think that's been crucial in supporting the performance of the existing ABS deals and the existing collateral as a whole. And perhaps another point to note that is perhaps more specific to these parts of the consumer market is the impact of the 2016 issues that had already driven in 17, 18 a change in the origination profile as a whole, and perhaps some risk reduction, some better practices in terms of servicing, and then some improvements in funding structure of the originators. So still that has, I would say, some of these originators actually, the larger ones in particular, had entered the crisis in a in a better position than they would have without the issues they faced in 2016. Far from perfect, but still better.
You know, Colin, we have a great question from the audience that I will first throw to you, but then please, Jack and Jennifer, you know, jump in as you feel appropriate. And this is a great example of how, you know, we talk about consumer ABS, and 2 o'clock is commercial ABS, but there are actually sort of these crossover areas. And so the question is what is your outlook on subprime small business lending, where both the consumer, or in this case, the owner's credit, and the business credit are all part of the underwriting, typically in the form of a guarantee, as well as you know, credit reports, et cetera?
Yeah, it's an area that we've been spending a fair amount of time before, through, and the crisis, and now as well. It is, I would say that you really have to look to split the pre-pandemic origination and the new origination in this case. For the pre-pandemic, there are challenges ahead. I think that there's no denying. For the shorter collateral, you might have helped some of these businesses pay these shorter loans they would have had. For longer exposures, I think that it's postponed the issues, and then we're likely to see more of it. And as far as ABS goes, in particular, we've seen the issues in the small business loans ABS, but in the end, it all went fine, partly because of the support that these businesses have been able to access. For new origination, I think the new origination guidelines, as much as the restart of the economy, will actually create great opportunities for attractive origination, simply because of the combination of a demand for credit that will be created by renewed activity. You know, shops reopening, a restaurant is closed, a new one will open, and if you're lending to that new business opening, actually you might be in a pretty great position, and therefore I think there is a potential for an increase in origination and issuance, and with very attractive performance potentially.
You know, I found that, and Jack, I think you're about to jump in, and I'll let you. I found it surprising as I was walking through areas where businesses had closed, and this is back in even June, July, in August of last year, and there would be a restaurant that was shut down, and there'd be a sign up like a new restaurant coming soon, right in the middle of COVID, and it didn't seem like a good idea to me. But
well, you're looking cheaper rates.
Yeah. Locking in the cheaper rents.
Yeah, free rent and all that sort of stuff. And I guess if you have the liquidity to deal with it, it's not a bad time. I think, Jack, maybe you wanted to jump in.
Yeah, I was just going to say on the small business stuff, it's interesting because I think my personal concern with some of that stuff has always been like you're underwriting to a combination of business credit and consumer credit, but it's probably not a business you'd lend to standalone or a consumer you'd lend that much money to standalone. That said, I mean, you know, I think on the security side, the way those structures worked actually kind of held up right through the performance, or through the pandemic. You know, in terms of performance, they delevered. You know, the bonds got paid back really quickly. They're very short, as you mentioned, Colin. You know, I think if you know, I'm less familiar with the economics of the whole asset, but my guess is, you know, that may have been a little bit more challenged. You know, way far down the stack. And I guess maybe if I could throw a question back, you know, that applies to both the short-term small business and short-term consumer. Like, I totally agree, and I think that was part of what I said in the outset, that in the short term, these things seem like they're going to outperform. You're earning a lot of carry. People are able to make these payments. I guess for those of us that have kind of permanent reinvestment goals, like, how do you determine when to stop, or like when we've reached the point at which, you know, the short-term nature no longer helps? Like, how do we think about that?
Yeah,
I'd throw that out to the panel.
I was just gonna say, can I also add on to that question for you, Colin? Sorry, it's getting on Colin Day. You kind of talk about those asset classes, and you hear structures being tested have not been tested through a recession. Would you consider what we went through the pandemic good recession type testing of those sectors?
Such as marketplace lending, you mean, Jennifer?
Such as marketplace lending, yeah. Sorry.
So I think it's a very, as each recession, it's a very specific test.
I think we're.
I think we lost him.
Yeah.
Yeah, we're losing Colin.
Y'all ganged up on him.
Maybe we can Colin until he can come back to us.
16 test.
His answer sounds pretty good, I bet.
Jennifer, I'm going to take a crack at that.
Go for it.
Which is, I do not believe it's been an appropriate test. Our recession lasted 2 weeks. My lights just turned off in my office. The recession lasted for 2 weeks, and it's like you went to sleep, you woke up, and it was over. And we otherwise don't have a true recession test. And Jack, you brought up something which which sort of goes in line with what I was curious about, and we have only 3 minutes left. What areas then would you avoid? And certainly small business was tested, and maybe some other esoteric areas were tested. And small business of all the areas was probably the one hardest hit during the pandemic. But looking forward, understanding that stimulus may be ending. But Jack and Jennifer, what areas would you avoid?
You want to take that first, Jennifer? Or?
Sure. I mean, I think, the one good thing about ABS is the structure. So, and a lot of it you do still get out, even in a times that are tough. I mean, I think now you start to think about, do you do home loans versus be a part of a structure? That's where, taking advantage more of the protection of the structure in the long term becomes more a factor, in my opinion. Or maybe where you are in the capital structure, maybe staying away from a single B and moving up to have that protection in the structure. I think, in most sectors, it's going to be also a factor of issuers. It's going to be more issuer, in my opinion, specific versus
more micro than macro, in other words.
I think so. That's my belief. Yeah.
Okay.
Yeah. And so, what I would say is, generally speaking, my preference has been to skew more prime than subprime, just given the dynamics. I think clearly that's something that also depends on your investment horizon, right? Mm-hmm. So I think that's definitely something that we're thinking about in terms of, is the long-term view the right view to take at all times? And from a sector perspective, I think that also lends itself to, avoiding, like Colin was mentioning, areas where we may have seen masked performance over the last 12 months and things could have been worse, and trying to, pick out what those might be, because those are the things that are really going to have problems, 12 months from now. So, I think we're all kind of operating in a bit of an information vacuum. And so I think, we've continued to kind of skew towards, kind of stable, prime, well-positioned borrowers. But I think there's definitely areas of opportunity in some of the subprime products.
And I'll finish up, because at FIIN, our focus is providing liquidity to companies, and we're always hunting for yield. And in this particular environment, finding yield is very difficult. So the prime is a tough area for us to go because yields are so low. And so we tend to go for those areas. And welcome, Colin. Colin is back. just in time for me to thank him for participating on today's panel. But
Sorry for that.
golly, we're sorry we lost you. Jennifer and Jack, our 40 minutes is up, and we had, I think, a lot more that we would have liked to have covered, but I want to thank you again, and thank IMN and Fixed Income Network for allowing us to do this, and for participants for participating. And with that, I'll throw it back.
Thanks for hosting,
Thanks,
Stacy.
I know, thank you.
Thank you very much.
Thanks, everybody.